Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer and be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. Again, this show, as always, is concerning Market Chameleon tools and products. With that, good Monday morning, Dima.
Good morning, Will. How are you?
Good.
Um, yep, good morning, everyone. And so let me share my screen here. And if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it. He'll let me know and read it back to me. And in the meantime, to give you a couple minutes to type in those questions, we're going to start taking a look at our pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we will move on to our questions. So let's start out here, pre-market report. Up here, you're going to see this calendar view and summary statistics, what happened in the pre-market hours on those specific dates. The idea there is that you could compare today's activity to the most recent history and eyeball if there's anything unusual or a trend. Let's review today's activity over here, August 19th. You could see so far we have 516 stocks trading higher, 315 stocks trading lower in the pre-market. We have 246 million shares trading on up volume, 40 million shares trading on down volume, and we have $3.4 billion worth of stock trading higher, $1,717 million worth of stock trading lower. So from this perspective, it looks like the pre-market trading has a bullish bias. Let's look at it from a couple more perspectives, and then we will move on to our questions. So I'm going to slide down the page a little bit. And now you get this more granular view of what's going on in the pre-market hours. We see stock symbols, price changes, volume. We also see our most active stocks, our biggest percentage gainers and biggest percentage decliners. Here, we come down here, we see 44 stocks made it onto our biggest percentage gainers list, 38 on our biggest decliners list. And from that perspective, it looks like a mixed bag, slightly more bullish maybe from this perspective. Now, to make it onto this list, we do set thresholds in place for these stocks because they could trade with very low liquidity, low volume. And if it meets our thresholds, the stock can make it onto this list, and it will include small cap stocks. It could include an ETF, could include a leveraged ETF or an inverse ETF that moves in the opposite direction of the underlying, maybe even a preferred stock closed-end fund, and so forth. So to narrow down this group of stocks further, we could use the filters above. We have this filter here in my watch list, and you'll see that in other reports or screeners. And that allows you to screen out, the particular report you're on by stocks that you saved in the watch list. So if you track a group of stocks that you like, you could screen those out using in my watch list filter. We're going to use this filter here in ETF, for example. And it's a similar concept. I'll show you how that works. If you click on it, you get this drop-down menu to select from. These are different ETFs. Let's go with the first one, SPY. So when you click on it, what happens is this report below will get filtered by stocks that are holdings in that ETFs. So here what we did was we narrowed down the group of stocks we're analyzing to the S&P 500 companies, because that's what the SPY is. And here you could see that there are 5 stocks that made it onto our biggest percentage gainers list, 1 on our biggest decliners. So not big list, but slightly from this perspective, looks like there's a slight bullish bias. So we gave it a couple minutes. If you have a question, I'll take it now.
Yeah, nothing's popped up yet, D.
Okay, so let's flip to.
Before you get started, can I share my screen before you get started discussing a new topic?
Yeah, let me see what we can discuss here while you're doing that.
All right. All right, it's shared. What do you think you're going to talk about this morning?
Yeah, let me grab my screen here.
All right, there you go.
Okay, so I think what we'll do is maybe continue on our conversation from last week. And I'm going to use the Amazon options chain. And let's just review what we were talking about. I'm going to go to a specific expiration in Amazon. So you could see here that in this options chain, there are different option expirations available for trading. And those are listed here on the left-hand side. And near that, we see the implied volatility that for the at-the-money implied volatility for that expiration. Next to it, we see the change in the at-the-money implied volatility. So this is comparing the previous day's at-the-money volatility where it closed to the most recent. So we're looking right now on Fridays. As of Friday's close, we're not open right now today. And then next to that, we see the volume or the number of contracts that traded in that expiration. And this lets you really quickly eyeball what's going on in Amazon by those different expirations. You see what the expirations available to trade, they're at the money IV, the change, and the volume. So then if there's something in particular you see from there, let's say we look at September 20th and we notice that there are 76,000 contracts that traded there. Well, that could be something interesting. And if you click on it, it'll take you to that September 20th expiration. So you could see here Amazon September 20th, 24 trading days and 35 calendar days until this option expires. All right. Now, when we look at this options chain, and we should probably go over it. I don't go over it enough, but let's just review the content of what we see. On these columns over here on the ends, you'll see there's a delta and a delta. These columns that are in the corners, they are changeable. So if you see this drop down menu, you click on it, you could select one of these options. Okay, we're gonna just keep it on the delta. And next to it, you have this volume. So you can see this options chain is separated. Call options on the left-hand side, put options on the right-hand side, and in between you have the strikes. Okay, so this volume here on the left-hand side, it's associated with this particular call, right, on the strike. And really this just allows you to see how the volume is distributed by the options in that expiration. And if you wanted to just find the most active call and put, we do have these buttons up here. So if we click on it, then here we go. You can see the 200. That's the 200 strike call. Had 9,200 contracts. And here we go, 140 put, traded 14,920. And this just a quick reference to see where there was the most trading, the most volume. Okay. Next to it, next to the volume, we have the price of these options. Okay. So we have the bid price and the ask price. So well, let's do the 200 strike. We see that the bid for the option is 53 cents and the ask is 55 cents. And there, that shows us the market, right? The current market, because when we see a bid in the market, that's a firm bid. So as long as that limit order is there, if you sell it on that limit order, then you're obligated to trade. If you buy it on the 55 cents and it's there, they're obligated to sell to you, you're obligated to buy. So those are like firm quotes. And next to it, on the what this bid IV is and ask IV, those are the implied volatilities. When you run the option pricing model, that's what the implied volatility is of the bid. And this is the implied volatility of the ask, because part of calculating the implied volatility of an option is it's the price of the option, right? The price of the option is higher, if the premium is higher, then the implied volatility will be higher. If the time premium is lower, then the implied volatility will be lower. So those are the implied volatilities of the option, and it lets us then make a relative comparison of the option prices. Because when we look at option prices, they're different, right? But part of the option price is how close it is to, or if it's in the money or out of the money, or at the money. So to make a relative comparison of these options, we could look at the implied volatility, right? Because that's one way to make a relative comparison of how expensive or how cheap they are relative to each other. So think of it as if I have two stocks, right? If I have a stock A and stock B, and if I know the prices of the stocks, like let's say, one is 10, one is 100. Well, that's the price of the stock, but how do I compare the two on a relative basis besides just the price, right? So there are different ways to do it. We could take the earnings per share, and then we can make a relative comparison by its P/E ratio, right? So the price at that point wouldn't mean as much as like where we make a relative comparison. Or we could take the price of the stock multiplied by the shares outstanding, and then find out what the market cap is of one company versus the market cap of another company. So even though there's a stock with at $100 a share, well, the amount of shares outstanding could be small, and there's another stock $10 per share, but the number of shares outstanding could be very large, so the market cap of that $10 stock could be much higher. So the implied volatility is important because it allows us to make those types of relative comparisons, okay, based on the option pricing model. Then we have this IV percentile rank. And what this does is, and by the way, if you click on it, you get more information. Some of these, if you hover over, you click on it. So just to give you an example, like if I click on that, I'll get more detailed information. So let's just look at the top number here. This looks back at options in Amazon that had similar characteristics historically. So it would look at number of days to expiration, trading days, the strike distance from the spot price, similar situation, earnings or non-earnings. And so it looks at all those and then says, okay, give me those observations, historical snapshots that with options that looks, were similar. And let's look at the implied volatilities of that option, because you could see here that these options all have different implied vols, right? Because some options are in the money, some are out of the money, some have very far distance away, some are close to at the money. So what this will do is say, okay, just looking at this particular option, right? Because a stock doesn't have an implied volatility. Think of this as implied volatility is derived from option prices. A stock itself, Amazon does not have an implied volatility. It has a stock price, it has a market cap, it has earnings per share, but it doesn't have an implied volatility. Implied volatility comes from the option prices. So what this does is look at this particular option and say, okay, if this option right now, the implied volatility is between 26.5, 26.8. So let's use the midpoint, right, of it. Let's say whatever it is, 26.6, whatever. And then look back in history and say, is that high or low? How do we, now we need another relative comparison, right? We need to know, well, okay, we could compare it to these other options, but also what about to history? And that's what this IV percentile rank does. It looks back in history of similar options and then compares the implied volatilities of those to the implied volatility of this option here. And how do we come up with a metric to see where today's implied volatility is relative to history? Well, one way, there's not one way, there's many ways, but one of the ways that we could compare it is create an IV percentile rank. And what this does is it takes the observations of history. Let's say we have 250 observations. And then it says, give me the percentage of those that fall below this current IV, right? So this is saying that 53% of the historical observations were below, which means that 47% were above. And it gives you an idea, an idea where the implied volatility we're looking at right now falls in which percentile rank based on the historical observations. Right, so look, 53%, click on it, and what this will do is say, okay, here's the history. See, past observations, calls in Amazon with 24 days to expiration. So 24 trade, it looks at trading days, okay? And it looks at 13% away from the spot price. Because keep in mind, not every option is the same, because there are options that are at the money, out of the money. So this one looks at those characteristics. And then it says, okay, plot options that are similar to this. You're not going to always get exact 13%, but it's looking at the closest ones. And it says, show me the implied volatility of those options. And that's what this graph is. This one goes through time, right? So these are the implied volatilities. And so we could see them graphically here. And those are the green dots. Okay, those are the green dots you could hover over. Well, how does that compare to what today's implied vol is? Well, that's that dotted red line. So that dotted red line shows today's implied volatility versus the history and in time. So you could see sometimes it jumps way above. So I guess this doesn't probably include all the observations, including earnings. So you could see here, sometimes it goes way above, sometimes it goes below, but like it's right there. And just graphically looking at it, you can see that, yeah, when it's below, it doesn't look like it falls. Well, I don't know. Down here, maybe it does fall well below. But this gives you a visual representation. And above that, we have some summary stats. So here's the current market, 26.5, 26.8, right? So that's just repeating what we saw here. And then we also have, the percentile rank, 53%, which that's what we saw from the options chain. We also get a couple more stats here. We see the average of all of them, 27.6. So you can see if we just average them out, straight simple average, 27.6, which is above, the market. What about the median? So the median is where half of the observations are above, half of the observations are below, and that's 25.5. So that's below the current market, which makes sense because we're 53rd percentile, right? What about the range, historical range, the high-low range? Well, that's over here. We got 17.7 versus 49.6. So you could see that the historical range, it's pretty wide, and you could see the extremes, right? From 17.7 to we had a 49.6% or 49.6 IV. So that's that. And you can change the graph here if you want to zoom in on a specific period. Okay. I'm going to close this. And same thing for the puts. That will be on the right-hand side. Now you do see some colors here. Okay. And they kind of try to point to things, okay, based on certain criteria. And you have this theoretical value in between the bid and the offer. So the theoretical value itself, it's calculating or estimating what is the value of this option if we applied a certain criteria. Okay, so that comes from here, theoretical values, and you could use different types of models. Okay, but let's first just discuss what this theoretical value means. And it helps to make a quick, assessment of the value of the option if you apply a certain criteria. So let's just say that you have, a criteria to, value a piece of real estate based on its cap rate, right? Price, the rent to purchase ratio, right? So if you have that criteria, then you could kind of input that in and just try to see, well, how is the market price high or low based on that criteria. So that's the theoretical value. We applied a certain type of assumptions or criteria, and we created, like, in theory, this option is worth this much. How does that compare to the market price? Okay, so right now, what is the default? Well, the default says if we took the Black-Scholes model and we took the implied volatilities of each of these options, okay, and we ran it through a best fit curve. So the idea is that we have all these different options that have different strikes. Right? So they have all these different strikes with different implied volatilities. Well, if the implied volatilities are different everywhere, logic says that that as they move from strike to strike, the curve or the skew should look smoother, not jaggedy, right? Because a jaggedy curve could imply something, um, perhaps like a a an order on the book, a pump in somebody's quote, and so forth. So what it will do is say, okay, give me all the implied volatilities and look at the different strikes and run a best fit curve. Okay, so that's what it's doing, best fit curve. And it says, based on that best fit curve, if I took those implied vols and plugged them back into the option pricing model, what would the theoretical value be? That's what this here is doing. Okay, for the calls and the puts. Of course, you could change that and use, let's say you wanted to use the 20-day historical volatility of the stock. And you say, well, what if I took the 20-day historical volatility, just like I clicked here? So it looks at the stock price and says, run the last 20 days, the open, high, low, close, and calculate the implied volatility in the last 20 days and plug that into the Black-Scholes model or option pricing model that we're using. And what would be the theoretical value of each of these options? So you select that, press OK. And now we get new theoretical values. So here, let's say what was it, 200. So based on the option pricing model, if the stock itself, has a volatility that looks similar to the last 20 days, if we applied that volatility into the option pricing model, what would this option be priced theoretically? That's 79 cents. Okay. And you could compare that to the market price of 53 cents and 55 cents. So that would look reasonably priced and a little bit below that theoretical value. Right. So that's how to change your theoretical values and quickly. Remember, when you're looking at a lot of numbers here, option chain has a lot of numbers. We start creating benchmarks and estimates so we could, make initial quick assessments, right? Because initially you want to kind of see if anything sticks out. And that's the idea behind there, that to make initial quick assessments. But I'm going to stop right there. We're right up at 9:30. So
yeah, that was awesome, Dave. Thank you so much. Great start to the week. You have a great day, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace.